Hey, GoldSilver, Alan Hibbard here. I've got another video for you, and this one is about real estate. I want to talk about residential real estate, commercial real estate, and how they are going to affect the banking sector. So let's get into it. First, I have an interesting chart here that I found on Twitter. This comes from Game of Trades. The median age of homebuyers is now 49 years old, and that's up from 31 years old back in 1980. So this is a very interesting trend. And I think it'll be no surprise to most of you that this comes from a decrease in affordability caused by massive currency creation that doesn't go to the little guy, goes to the big guy. So this has been getting harder and harder and harder for people to actually afford homes. However, it might be coming down. And what I want to look at today is how affordability might be improving. However, it's not as good as it sounds. So the median home prices are sharply contracting. Look at this. This is the yearly percent change in median sales price of houses sold for the United States. And you can see how many times the red line is above zero. When it's above zero, that means prices are going up and up and up. There's only been a few times where the red line is below zero, meaning there's only been a few times where prices go down. And you can see right now, prices are contracting at a level that we haven't seen in this entire chart. And it goes back to 1964. So we're talking about 60 years. Prices are dropping faster than they have in 60 years. And who knows if they've ever dropped this quickly. We don't have data going back that far. So it seems like the air is coming out of what is pretty obviously a real estate bubble. And if you're looking to buy a house, this could be good news. However, keep in mind that home prices don't exist in a vacuum. Okay. Economics is a closed loop and everything is connected. And that's what I want to talk about in just a second. But first, let's look at apartment rents. So rents across the country are beginning to collapse. In Salt Lake City, down 21% year over year. Raleigh, North Carolina, down 12% year over year. Las Vegas, 9% year over year. And in Austin, rents are down from almost $2,300 a month last December to under $2,000 a month in December. So rents are dropping, median home prices are dropping. And what I'm about to show you in just a second is office rent is also dropping. And again, that sounds like a good thing. If you're in the market for these things, you might get some relief. However, there's a ripple effect through the economy that might not be so good. So let's take a look at what that is. I want to go north of the border here to Quebec and talk about a Quebec pension hit with real estate losses as a hostile market persists. So it might not seem like a Quebec pension fund is relevant to you, especially if you don't live in Canada and if you're not a part of that pension fund. But again, everything is connected. So let's see what I mean. Quebec's public pension manager reported a positive 7% return in 2023. So positive return, that should be good news, right? Okay, as losses in real estate detracted from big gains in its credit and stock portfolios. Okay, the fund manager posted a 6% loss on its 46 billion Canadian dollar property portfolio. And that's the only asset class for which it had a negative return. So that wouldn't really sound so bad. But we know that so many of these asset classes are going up at the same time year after year after year, not necessarily because the assets themselves are strengthening, but because the currency creation is off the charts. And nominally, that causes the prices of everything to rise. So the fact that the real estate losses are the only asset class for which they had a negative return kind of shows you just how big of a loss real estate is, even in the face of that massive tailwind from currency creation. So even with all that currency creation, they still can't get a positive return in real estate. Very interesting. So Natalie Palatichev, the head of the real estate division, described last year's environment as hostile. She says high interest rates and low occupancy have created a difficult outlook for office owners and their lenders, with more than $1 trillion in commercial real estate loans set to mature by the end of the year. Okay. The increase in rates impacts both the valuation and the cost of debt. Okay, so the valuation of a property isn't going to be as high when interest rates are higher, right? That's time value of money. That's net present value is going to drop as interest rates go up. So the property isn't worth as much. And of course, the cost of debt is going to go up as interest rates go up because, well, simply you have a higher debt payment every month. So this is a double whammy. The valuation gets impacted and the cost of debt gets impacted because of those high interest rates. And we know that the Federal Reserve has been raising rates at the fastest pace in history. So now we're seeing the effects. We're seeing the effects in the real estate market. Finally, Natalie Palatichev says here about transactional volumes, okay? Real estate transactional volumes, they have been halved in Europe, halved in the United States, even an 80% drop in transactions in Germany, for example. That's massive, half the transactions. I'm speechless. This is crazy. Another article here comes from Bloomberg. The brutal reality of plunging office values is here. So this was inevitable. We knew this was coming. Now it's here. What's happening? Well, commercial property deals in the US are starting to pick up at deep discounts. They're forcing lenders around the world to brace for souring loans. Developers borrow money, they can't pay it back. And now the ramifications are upon us. The shakeout in the $20 trillion US commercial real estate market has long been delayed for a simple reason. No one could figure out just how much properties were worth. And more crucially, few wanted to. So there may be some truth to that. When loans aren't being paid, you're not sure how to value the property, interest rates are fluctuating a lot, you're not sure, is your building worth 300 million or 400 million? It's hard to know. And of course, the lenders here don't want to acknowledge big losses, so they kind of just put off the day that they have to, mark them to market. So what happens here? Well, in Manhattan, brokers have started to market debt at a roughly 50% discount. 50% discount. A prime office tower in Los Angeles sold in December for about 45% less than its purchase price a decade ago. Around the same time, the FDIC took a 40% discount on about $15 billion in loans it sold backed by New York City apartment buildings. So we're talking about 40, 45, 50% discounts here now that these lenders are actually reflecting what they think is the true value of these loans. And who's exposed? Well, of course, banks. Banks are most exposed to maturing property loans in the U.S. You can see banks here are in black. They're almost half of the exposure here. And this is, projecting this forward, I mean, this is going to be absolutely catastrophic for the banking sector. So even if you were in a position where, okay, you're looking to buy a house and you're relieved that prices are coming down, or you're renting an apartment, or you're renting a house, or you're looking to get office space for your company, okay, great. That's good for you in the short term. You're going to pay less. However, the economy is a closed loop. And as the ripple effects of this come all the way around, we're going to see banks that become insolvent. And the banking system is extremely incestuous. Everybody lends to each other. There's going to be massive losses, massive contagion, and that's going to affect all of the economy. So you personally might get a short-term benefit, but then as it comes back around, there could be massive, massive problems that affect all of us. Eventually, the banks will be left with no choice but to grapple with the black hole on their balance sheets and the ramifications of recognizing reality. Things just can't sit forever. If you have some trades and values are coming down, that'll force some of the mark-to-value conversations. So it's coming. You can't put it off forever. And the magnitude of the crisis is up for debate. Of course. Treasury Secretary Janet Yellen said last week that losses in commercial real estate, they're a worry, but the situation is manageable. You got to be kidding me. Manageable. Yeah, okay. Manageable. Yeah, just like subprime was contained back in 2008. Okay, same thing. Here we go again. And Fed Chair Jerome Powell agrees. Yeah. And then others who don't have political motives have more dire outlooks, with real estate investor Barry Sternlicht predicting $1 trillion in office losses. And again, economics is not a closed loop. So just because there's $1 trillion in office losses doesn't mean that it stops there and we all go on with our lives. There's contagion. It goes around. It affects the banking system. The banking system affects every other part of the economy. We're really only just getting started. And if you want to learn more, I encourage you to check out the video that Mike Maloney just put out not too long ago, The Looming Disaster in Commercial Real Estate Explained. He talked with Todd Sachs here, and they've got a great presentation basically explaining what this is all about and what it could mean for you. I strongly encourage you to check it out. And thank you so much for watching today's video, and thank you for being a part of the Gold Silver community. Stay safe out there.